Can you imagine a showroom boasting that it's the UK's most connected supercar dealer, pulling in 2.5 million views every week and displaying the likes of the Ferrari Enzo, Bugatti Veyron and LFA, collapsing in a matter of days? Dozens of consigners stormed the doors to reclaim Lamborghinis and Ferraris worth hundreds of thousands of pounds, while unsuspecting buyers had their cars seized by police because the previous owners had never been paid. Behind the glamour was a risky sale or return system, hidden debts, and a chilling statement from the owner. We've uncovered a major internal fraud. This isn't just one company's crisis. It exposes a toxic blend of greed, poor oversight, and naivety on the part of both sellers and buyers. With that shocking opening question, who is really to blame for GVE London's downfall? This piece will peel back every layer of the scandal. The profiles of the key players, the hidden numbers that brought it down, parallels with other supercar fiascos, and the hard-learned lessons to keep you from becoming the next victim. To understand the collapse, we need to trace the paths of the two central figures, David Rye and George Gedhu. David Rye is the founder and sole shareholder of GVE London. Starting from modest beginnings, he transformed himself into a supercar mogul through bold marketing on social media. Rye often boasted that around 80% of the cars in his inventory were sold on a sale or return, or SOR basis, meaning the vehicles did not belong to GVE but were consigned by owners. This allowed the company to operate without sinking millions into inventory, but it also created immense cash flow pressure. Every time a car sold, money had to be returned promptly to its owner. George Gedhu, famous from the company's TikTok videos, served as GVE's storyteller. Dressed sharply and bargaining on camera beside exotic cars, he attracted millions of views. Many viewers assumed he was a co-owner or executive. But when the scandal broke, Gedhu publicly stated, "I'm just an employee, not a shareholder or financial director. I have no say in the company's financial decisions." This admission revealed how blurred the lines were inside GVE. A marketing staffer had become the face of the brand, creating widespread confusion about who held authority and responsibility. The fallout was immediate. Gedhu said he and his family received threats because people assumed he controlled the company. Meanwhile, David Rye tried to pivot the narrative to an internal fraud, without naming any perpetrators or explaining how much money was missing or how the fraud worked.
Away from the spotlight lay numbers few expected. When new administrators, Arvinder Jit Singh and David Hinrichsen of FRP Advisory, took control of GVE, they released figures that stunned the industry. The company owed around £449,000 to 14 corporate creditors and about £700,000 to 9 individual customers, with an overall shortfall of about £1.8 million. Those were just preliminary figures. The true amount could be higher, as many consigners had yet to report their losses. Why did the debt balloon? First, GVE consistently filed its financial statements late. By late August 2025, the accounts for the previous fiscal year were still overdue. This was a glaring sign of a lack of transparency. Second, instead of holding sale proceeds in escrow, GVE is accused of using funds from one sale to pay off another consignor or to cover operating expenses. When the market slowed or sales dipped, this robbing Peter to pay Paul model quickly unraveled. It is also important to remember GVE's clout. With 2.5 million views every week and hundreds of thousands of followers, GVE had built enormous trust. Many consigners handed over their cars without scrutinizing contracts or insisting on escrow. When the scandal erupted, chaos followed. One consignor said he was still waiting on £66,000 for his Ferrari California T. A retired engineer was thankful he retrieved his £240,000 Lamborghini Huracan just in time. The GVE saga isn't isolated. It belongs to a chain of recent crises in the supercar market, particularly those involving the sale or return model. Happier Cars is a well-known example. It expanded rapidly through SOR, but collapsed when it used consigners' funds to cover unrelated expenses, leading to cash flow chaos. Smaller dealers have been accused of selling customers' cars without paying them or withholding deposits. These cases share several traits. Lack of escrow accounts. Dealers commingle revenue from multiple transactions into one operating account, making it easy to misuse funds. Late or missing financial reports. Like GVE, many firms filed late or incomplete accounts, yet authorities did not intervene promptly. The blinding power of social media, slick videos and influencer endorsements create trust that masks underlying risks. Weak internal controls and blurred roles. With little division of duties, almost anyone can access consignors' funds. Such parallels show that GVE's implosion isn't just a fluke, but a symptom of a systemic issue. Without strict controls, the sale or return model can resemble a Ponzi scheme in the supercar world.
From this saga, both buyers and sellers can extract crucial lessons. First, always insist on a clear, detailed contract when consigning your car. Don't settle for verbal promises. A written agreement should specify the listing price, the maximum time your vehicle will stay with the dealer, and the exact payment deadline. Include penalties for late payment and stipulate who is liable if the car is damaged on the forecourt. Keep possession of key documents like the V5C until you're paid in full. Without such protections, you risk being treated as an unsecured creditor if the dealer collapses. Second, demand that sale proceeds be placed in an escrow or client account. A separate, ring-fenced account prevents the dealer from using your money to fund other deals or pay overheads. Ask to see proof that your funds are held this way and confirm the bank details yourself. If a dealer can't provide such assurances, it's a red flag. Consider a different dealership or an alternative method of sale, such as a reputable auction house. Third, take the time to review the company's filings before you do business. In the UK, Companies House makes annual accounts and confirmation statements public. Late submissions, sudden director changes, or dissolved subsidiaries can hint at deeper issues. It's worth spending a few minutes online to verify the company's status and to search news articles or forums for complaints. Fourth, if you're buying a car, get a proper invoice in your name and pay through the dealership's official channels. Avoid transferring money to a salesperson's personal account or paying cash with no receipt. A valid invoice not only legitimizes your ownership, but also gives you evidence to pursue legal remedies if something goes wrong. Finally, recognize that high follow accounts and slick videos are not a substitute for due diligence. Influencer-driven businesses often thrive on charisma and lifestyle imagery, but these can mask operational weaknesses. Stay skeptical, ask probing questions, and consult legal or automotive experts when dealing with high-value transactions. Educating yourself now can save you tens of thousands later.
GVE London's spectacular implosion offers a sobering lesson about the perils of unchecked ambition and blind trust. The company's meteoric rise, fueled by breathless social media marketing, celebrity clients, and a daring business model, was matched only by the speed of its downfall. Overnight, consignors and buyers found themselves in financial and legal limbo. What looked like a well-oiled machine was, beneath the surface, a house of cards, held together by delayed payments and opaque accounting. This cautionary tale doesn't end with GVE. It sends ripples through the entire luxury car market. Regulators and industry bodies will have to reassess how sale or return operations are monitored. Perhaps legislation will emerge to enforce escrow accounts, audited trust funds, or regular financial reporting for dealerships handling third-party assets. Consumers, for their part, are likely to become more vigilant, asking harder questions and demanding more transparency. The scandal also forces us to reconsider the role of influencers and social media. Slick marketing can build a brand in record time, but it can also foster a sense of security that isn't deserved. When millions watch a charismatic salesman close deals on TikTok, it can create herd momentum that suppresses critical thinking. The GVE collapse underscores that trust must be earned through more than likes and followers. Ultimately, the story is a reminder that innovation and spectacle must be grounded in ethical business practices and robust governance. Balancing entrepreneurial flair with legal responsibility is not optional, it's essential. For buyers, sellers, and regulators alike, the experience of GVE London is both a wake-up call and an invitation to shape a more transparent and resilient supercar marketplace.